For over 60 years, India followed the same tax rulebook, but from April 2026, everything changes.
For over 60 years, Indian taxpayers have navigated the Income Tax Act of 1961, a document that grew through decades of patchwork amendments and thousands of legal clauses. The 1961 Act eventually became so weighed down by redundant provisions and archaic language that the government has decided to scrap it entirely. On April 1, 2026, the Income Tax Act of 2025 becomes the law of the land. It is a complete rewrite, removing the complexity of the old system to create a more streamlined framework for FY 2026-27. One of the first changes is purely structural. The 2025 Act merges the separate concepts of financial year and assessment year into a single unified term, the tax year. Beyond the vocabulary, 15 specific rule changes will dictate your tax liability starting in April 2026. These rules create a new landscape of expanded deductions for some and aggressive new penalties for others.
If you fail to adjust your financial planning to this new matrix, you risk facing unexpected tax bills. Mastering these specific shifts now is the only way to protect your wealth during the 2026 rollout. For the salaried middle class, the 2025 Act offers significant relief. Under the new regime, taxable income up to 12 lakh rupees remains effectively tax-free, thanks to the continued rebate under Section 87A. You can see the geographic expansion of tax relief on this map. The 50% house rent allowance exemption was previously limited to 4 traditional metros. Starting in 2026, this 50% threshold officially expands to include Bengaluru, Pune, Hyderabad, and Ahmedabad. The government is also increasing several common salary deductions for the first time in years. The monthly tax-free allowance for a child's education is jumping from 100 rupees to 3,000 rupees, a 30-fold increase that finally reflects the actual cost of schooling. Other limits are moving as well. The annual cap on tax-free non-cash gifts will triple to 15,000 rupees, and overseas medical treatments will remain tax-free for those earning up to 8 lakh rupees. These specific reliefs represent a strategic attempt to align tax-free allowances with the modern cost of living for the Indian workforce. While employees gain ground, the 2025 Act targets specific investment activities and trading strategies to offset those losses in revenue. Active traders will see an immediate impact. The government is hiking the securities transaction tax on both futures and options, effectively increasing the cost of every trade you make. The rules for share buybacks are also changing. Starting in April 2026, any amount received from a buyback will be taxed as capital gains rather than a dividend. For individual promoters, this means an effective tax rate of 30%. Investors in sovereign gold bonds must navigate a new split in the rules. Buy them during the initial issue, and they remain tax-exempt at maturity. However, if you buy them on the secondary market, those gains are now subject to capital gains tax. The deduction for interest expenses incurred to earn dividend income or mutual fund income is also being eliminated. You will now be taxed on the full dividend amount without being able to offset it against your interest costs. Finally, the tax collected at source on overseas tour packages is being simplified to a flat 2. But be aware, filing a revision after December 31st will now trigger a mandatory penalty fee. As you can see on this scoreboard, the paperwork you've used for years is being renumbered. Form 16 becomes Form 130, Form 12BB becomes 124, and Form 26AS is now Form 168. These renumbered forms are part of a push toward a fully digitized audit trail, giving the government more direct visibility into your financial records. The core of the 2025 Act is a shift away from complex language and towards strict digitized compliance. For example, to claim HRA under the 2026 rules, you must legally disclose your exact relationship with your landlord. This digital verification is designed to flag and prevent taxpayers from claiming deductions for rent paid to family members. You have until the April 2026 rollout to audit your own finances, review your F&O exposure, your secondary market gold holdings, and ensure your rent documentation is ready for these new disclosure requirements. The Income Tax Act of 2025 changes the rules of wealth retention in India. Understanding these specific mechanisms today is the only way to ensure you benefit from the new system when it arrives.
These new tax rules will impact every Indian, so don't wait. Plan smart, stay ahead. Subscribe to Fun Time with Samay for simple, powerful financial insights.